the market's in seek and destroy mode, isn't it? And the issue here is the bankers, the central bankers, need to get a fire break ahead of the market. Is this enough? I'm not sure it is, actually. I mean, this solves what I think is probably an idiosyncratic problem at Credit Suisse, but I'm not sure it's a fire break big enough to stop the rot for the market.
Let's just get into that. I mean, we're talking about a storied institution here in Switzerland, but one that became really scandal-clad and with lots of stories written about it in recent years. I think many are stepping back and saying, were the problems just too great to fix? Was it a matter of timing because we saw this banking contagion risk start to unfold? Do you think that the problems were really of Credit Suisse's making? Or is there something more here when we talk about now what's happened with COCOs, these bond instruments, the fact that investors have been hunting from one bank to the next looking for weakness at this stage?
Yeah, I think for the most of it, it's idiosyncratic for Credit Suisse. I mean, this is a bank that was making sort of mid-20s billion revenue per quarter as a run rate. Last quarter was making 11 billion, and over that period, costs have gone up, not down. So I think that's the key issue here. The rest of the European banking system is much more robust than it used to be. That's pretty clear. In terms of the AT1s, it's interesting. I mean, I think a lot of people will have taken a sharp intake of breath when they saw the mezzanine debt wiped out, as it were, but equity not. Now, if you look at the details of the AT1 bonds that they've wiped out, it's very explicit that, particularly in the case of government intervention, that is possible and in fact quite likely to happen. So
it's a trigger event, right?
That's right, exactly. So I think it's a case of caveat emptor on that one.
James, obviously Jeff's been leading our coverage on this and it's out in Zurich once again and has got a couple of points for you. James.
Yeah, good morning, James. Ironically, I want to sort of widen out the view here because I'm intrigued by the point that you're making where you suggest perhaps this won't bring stability to the market in the way that the regulators would like. And let's face it, they all rushed out in a coordinated fashion to say how much they welcomed this deal and how important it would be. But at the same time, we got this very interesting announcement overnight as well about swap agreements, which again suggests that perhaps there are some problems, some ripples emanating from the dollar market that imply that people are finding it difficult to get dollars to settle trade. The increase in interest rates is increasingly tightening up liquidity in the global economy. This implies, I think, that the authorities are concerned about what is going on below the surface here. I'd be very interested in your broader take and what ultimately you may think this now means for where we are on interest rates and what we may now see in terms of central banks injecting liquidity back into the system rather than trying to extract it.
Yeah, I mean, look, the big picture from the Fed's point of view, isn't it, is that it's pumped in around 700 trillion over the 700 billion, sorry, over recent months, and that's really started to come down with QT. I think incrementally this is pretty obviously going to slow that, and as you say, there has been incremental liquidity added back in. Inflation is coming down, and it's coming down quite quickly. If you look at the lead indicators, that's pretty obvious. So I think this just adds to that, and we say, you know, we're somewhere at peak inflation, peak interest rate fears now, and that's probably ultimately what will stop the rot. But I think this deal specifically probably isn't a big enough fire break to do that.
And that's all very fascinating as well. So it's not a big enough fire break to end systemic concerns or end individual bank concerns as well. So I'm not looking to sensationalise anything, but it is our job to ask you which other banks you feel are potentially at risk. And with that, I'll ask you what your positioning is as well.
Yes, a bank I don't own would be something like a Deutsche Bank, you know, a very...
Which has made a lot of progress on its recovery under Herr Dr. Christian Sewing, and yet...
And yes, it's still got a very large derivatives book linked to the investment bank, and I think that's the issue here. It's the uncertainty the market doesn't like. What I think isn't going to spread, where it will stop this time, because we have got much better resolution tools in Europe, where it will stop is with the wider banking system. So, as I say, it's a seek and destroy mode from the market. It's picking off individual banks, but I don't think it becomes systemic in terms of encapsulating every single bank. the simple retail banks, they should be fine.
It's a good description, isn't it? As we talk about CoCos too, I think Deutsche Bank was the story we first started talking about CoCos a lot in recent years. I want to ask you more about the UBS Credit Suisse deal now, because effectively there were hurdles for so many years. I mean, this is not a new story for us in terms of the consolidation. We've been talking about it for a long time. We know they're very motivated parties behind the scenes, but it was a deal that just couldn't get done. And if we talk about what this means now, you've got this domestic concentration in Switzerland, one major global bank, about 30% of the domestic banking business now under the UBS Credit Suisse banner. Internationally, you've got a very large bank, 1.1 trillion in total assets for UBS, but businesses stretching across the globe at a time when the American peers have really had the edge. So what does it mean for this entity competing globally, but also in terms of the domestic concentration?
Look, well, I listened to the conference call last night, and the tone struck me. It was a very defensive tone initially from the management of UBS. It's not a deal they wanted to do. They were quite explicit about that. But as you say, all the presentation talking material was actually pointing quite positively. So I think, in the short term, the market's not going to like this deal for UBS. It's not core to the strategy. But I think over the medium term, you're right, that it does potentially give them an edge to compete globally with the Americans and really puts them in an unassailable position domestically. They've really overtaken Raiffeisen as the big domestic bank in Switzerland, and that puts them in a good spot.
One more for you out of Zurich, Jeff.
Yeah, James, to what extent does this give us then a precedent for understanding what any future wind down of a systemically important bank could look like? And I point in particular to the use of emergency powers by the authorities to take this vote out of the hands of the shareholders. It sends a very interesting message, I think, to equity owners around the world about what may happen in similar circumstances at other organisations. What do you make of it?
I would say that it's been helpful, the resolution tools that we've had in place. It has made it easier to do this deal. As we've pointed out, there's about 15 billion of additional equity provided by the wipeout of the AT1s. There's 30 billion in badwill, which is effectively equity that the UBS is getting, plus they're getting another 9 billion of guarantees. So there's a huge amount of sort of value that UBS is buying for just 3 billion. But it wasn't enough, was it? For all the tools that we had in place, when it came to it, we weren't able to do a fundamental restructuring and resolution of a GSIB, a globally systemic bank, without involving a private sector and using central bank fudge factors.
James, this is literally a 5-second answer. Are you buying or selling bank shares this morning if you get an opportunity?
I think if they're down significantly, I will start to nibble at something, and possibly even UBS actually.
Do you want to give our viewers a little idea of what you're nibbling at?
Or
would that just actually spoil the trade for you?
I think that might be a little bit close, but something like a UBS might be interesting if the shares were down, double digit or more.
Hi, I'm Joanna Bersecci, and thank you for watching. You can check out more of our videos by clicking on the boxes on the screen. And don't forget to subscribe to our channel for more from CNBC International. Thank you for watching.